Are U.S. banks actually safe in 2025? Because right now, as you're watching this video, 99 federally insured American banks are quietly failing. Not struggling, not in trouble, failing, and the government won't tell you which ones. 3 months ago, the FDIC updated its problem bank list. They added multiple banks in the last 90 days alone. The list is now at 99 institutions, double what it was just 2 years ago. And here's the terrifying part. They refuse to publish the names. Why? Because revealing which banks are collapsing would trigger the exact panic they're trying to prevent. And before you think this doesn't affect you, your bank may already be on the list. But panic or not, the math doesn't lie. Commercial real estate is imploding. Deposit flight is accelerating. Unrealized losses are buried on balance sheets across the banking system. And if you think 2023's Silicon Valley Bank collapse was bad, what's coming in 2025 could be catastrophically worse. So here's what we're going to do in the next 20 minutes. I'm going to show you exactly why 99 banks are on the brink, what the FDIC is hiding, how to tell if your bank is one of them, and most importantly, how to protect your money before it's too late. Because the government won't warn you, but the data already has. Let's rewind for a second. If you've been paying attention to the banking sector, you know 2023 was brutal. Silicon Valley Bank collapsed in March. Signature Bank went down days later. First Republic followed in May. Billions of dollars evaporated. Thousands of businesses lost access to their funds. And the FDIC had to step in with emergency bailouts just to stop the contagion from spreading. But here's what most people missed. Those failures weren't isolated incidents. They were symptoms of a much larger disease that is still spreading through the banking system right now in 2025. The economic environment today is more dangerous than it was in 2023. Interest rates are still elevated, nowhere near the 0% era that banks got comfortable with. Commercial real estate is in free fall. Office buildings are sitting empty across America. Credit card delinquencies just hit a 15-year high. And deposits, they're fleeing traditional banks at record speed, pouring into money market funds and treasury bills that offer better returns with zero risk. In 2024 alone, over $800 billion quietly left U.S. banks, mostly from regular people like you who just wanted a better rate. That's not a banking statistic. That's your neighbors, your coworkers, people in your community pulling their money out because they don't trust the system anymore. Here's the brutal truth about banking. It runs on confidence. Not math, not logic, confidence. The moment people stop believing their money is safe, the entire system collapses. And right now, confidence is cracking. You can see it in the data. You can see it in the deposit outflows. You can see it in the 99 banks the FDIC has quietly labeled as unsafe. The question isn't if more banks will fail. The question is how many, how fast, and whether your bank is one of them. All right, let's talk about the list everyone's afraid to mention. The FDIC Problem Bank List. This is a secretive, internal document that categorizes banks as unsafe or unsound based on strict federal criteria. And right now, 99 banks are on it. Here's how it works. The FDIC doesn't just randomly pick banks to label as problems. They use a rating system called CAMEL's Capital Adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. If a bank scores poorly across these categories, it gets flagged. And once you're on the problem bank list, you're in serious trouble. But here's the insane part. The FDIC refuses to publish the names of these banks. They claim it's to prevent panic and bank runs. And yeah, I get it, Tiff. Tomorrow morning, the government released a list of 99 failing banks. People would line up to withdraw their money immediately, but the secrecy creates a different problem. You have no idea if your bank is one of them. Let me put this in perspective. Okay. In 2021, there were only 51 banks on the problem bank list. By 2023, it climbed to 52, and now in 2025, it's 99. That's nearly double in just 2 years. And the FDIC keeps adding more every single quarter. So what lands a bank on this list? Let me break it down into 5 red flags. Red flag number 1, liquidity risks. The bank doesn't have enough cash on hand to cover withdrawals if customers start pulling their money out. Red flag number 2, asset quality breakdown. The bank's loans are going bad, borrowers are defaulting, and the assets backing those loans, like commercial real estate, are losing value fast. Red flag number 3, unrealized losses. This is the silent killer. Banks bought U.S. Treasury bonds and mortgage-backed securities when interest rates were near zero. Now those bonds are worth 20, 30, even 40% less than what the bank paid for them. Think of it like this. It's like buying a house for $500,000, that's slow, worth $300,000, but pretending the loss doesn't exist because you haven't sold it yet. They haven't sold these bonds yet, so the losses aren't realized. But they're sitting there like ticking time bombs on the balance sheet. Red flag number 4, capital problems. The bank doesn't have enough reserves to absorb losses. If a crisis hits, they can't cover it. They're undercapitalized and vulnerable. Red flag number 5, exposure to commercial real estate. Office buildings, shopping malls, hotels, these properties are tanking. And the banks that lent billions of dollars to finance them, they're drowning. If a bank checks multiple boxes, it ends up on the list. 99 banks just checked enough boxes to qualify. The FDIC knows they're in danger. They just won't tell you which ones. If you're still with me right now, you're already ahead of 99% of people who have no idea their bank might be failing. Drop a comment if this is making sense. Let me know you're paying attention, because what comes next gets even more serious. So why is this happening now? What changed between 2023 and 2025 that pushed 99 banks to the edge? Let me give you 4 specific triggers that are creating a perfect storm for a banking crisis. These are the exact same pressure points that triggered 2008, but now happening faster and at a larger scale. Trigger number 1, the commercial real estate meltdown. Office spaces across America are sitting empty. Work from home became permanent for millions of people. Companies downsized, leases expired, and now commercial property values are collapsing. The problem? Regional banks lent billions to finance those office buildings, and those loans are defaulting at alarming rates. When the properties get foreclosed and sold, they're worth 30 to 50% less than the original loan. That means the banks eat massive losses. And small regional banks don't have the capital cushion to survive that. Trigger number 2, unrealized losses on U.S. Treasuries. This is the exact problem that killed Silicon Valley Bank. When interest rates were near zero, banks bought long-term Treasury bonds yielding 2 to 3%. Safe investment, right? Wrong. When the Federal Reserve jacked rates up to 5 to 6%, those old bonds became worthless. No one wants a bond paying 2% when new ones pay 5%. So the value of those bonds crashed. Banks are sitting on hundreds of billions in unrealized losses. And if they're forced to sell those bonds to cover withdrawals, the losses become real. That's when banks fail. Trigger number 3, deposit flight. People aren't dumb. They see money market funds offering 4 to 5% interest with zero risk. Meanwhile, their bank savings account pays 0.5%. So they're moving their money. Billions of dollars are leaving traditional banks every single month. And when deposits leave, banks lose their primary source of funding. They can't make loans. They can't generate revenue. And if the outflow accelerates, they run out of cash. Trigger number 4, shadow run risk. Bank runs don't happen the way they did in the 1930s anymore. You don't need people lining up outside with pitchforks. Now it happens digitally in hours instead of days. Corporations and big clients can move millions with a single wire transfer. And once the run starts, it's nearly impossible to stop. Technology has made banking faster, but it's also made bank failures faster. One bad headline, one credit downgrade, and a bank can collapse before the FDIC even has time to intervene. These 4 triggers are active right now. They're not hypothetical. They're not worst-case scenarios. They're happening, and 99 banks are caught in the crossfire. All right, let's get personal. Is your money actually safe? Because this is where most people get dangerously overconfident. They assume the FDIC has their back no matter what. And technically, they do up to a point. Here's the rule. The FDIC insures deposits up to $250,000 per depositor, per bank, per ownership category. So if you have $200,000 in a checking account at one bank, you're covered. If you have $300,000, only $250,000 is insured. The other $50,000, you're on your own. But here's the part they don't tell you. The FDIC insurance fund only has about $128 billion in reserves. Sounds like a lot, right? Until you realize that U.S. banks hold over $18 trillion in deposits. That means the FDIC can cover roughly 0.7% of total deposits. Less than 1%. So what happens if a big bank fails? Or worse, if multiple banks fail at the same time? The FDIC doesn't have nearly enough money to cover everyone, and that's when the government steps in with what's called a systemic risk exception. They did it in 2023 with Silicon Valley Bank and Signature. They made all depositors. But here's the problem. Systemic risk exceptions are political decisions, not automatic guarantees. The Treasury Secretary, the Federal Reserve, and the President all have to agree. And there's no rule that says they have to protect everyone. In practice, big clients with millions in deposits get rescued first. Small account holders, you're at the back of the line. So if your bank fails tomorrow, here's what actually happens. If you're under the $250,000 limit, the FDIC will eventually make you whole. It might take days, maybe weeks, but you'll get your money. If you're over the limit, you become a creditor in the bankruptcy process, and you might get 60 cents on the dollar, or 40 cents, or nothing. The FDIC won't let the system collapse entirely, but they also won't save everyone. And if you're counting on them to protect every penny you have, you're gambling with your financial future. All right, quick question. How much money do you have in your bank right now? Don't tell me the exact number, but comment under if you're under the FDIC limit, or OVER, if you're over $250,000. I want to see how many of you are actually at risk right now. Now here's the part everyone wants to know. Which banks are actually in danger? And unfortunately, I can't name them. The FDIC won't release the list. And publicly accusing a bank of being insolvent without hard proof would be legally reckless. But what I can do is give you the exact red flags to look for so you can evaluate your own bank. Here are the top 5 warning signs that your bank might be in serious trouble. Warning sign number 1, rapidly closing branches. If your bank is shutting down physical locations at an accelerated pace, that's not just about going digital. It's about cutting costs because they're losing money. Healthy banks expand. Struggling banks shrink. Warning sign number 2, aggressive high-yield savings promotions. If your bank is suddenly offering 5, 6, even 7% interest on savings accounts, ask yourself why. Banks don't give away free money. They're desperate for deposits. They're trying to stop the bleeding. And desperation is not a sign of stability. Warning sign number 3, negative trending earnings for 4 or more quarters. Go to your bank's investor relations page. Look at their quarterly earnings reports. If they're posting losses or declining profits for multiple quarters in a row, that's a major red flag. Profitable banks don't fail. Unprofitable banks do. Warning sign number 4, high exposure to commercial real estate. Look at your bank's loan portfolio. If a huge percentage of their lending is tied to office buildings, shopping centers, or hotels, they're vulnerable. And if those properties are concentrated in struggling markets like San Francisco, New York, or other major cities with high vacancy rates, the risk is even worse. Warning sign number 5. Low or declining Tier 1 capital ratio. This is a technical metric, but it's critical. The Tier 1 capital ratio measures how much high-quality capital a bank has relative to its risk-weighted assets. Healthy banks have ratios above 10%. Struggling banks drop below 8%. If your bank is trending downward, that means they don't have enough reserves to absorb losses. Let me give you 2 anonymized case studies to show you what this looks like in practice. Case study number 1, a regional bank in the Midwest. This bank has $8 billion in assets and a heavy concentration in commercial real estate lending. Over the last 2 years, they've closed 15 branches. Their earnings dropped 40% in 2024. Their Tier 1 capital ratio fell from 9.5% to 7.8%. And they're currently offering 6% interest on savings accounts to attract deposits. Every single red flag is flashing. This bank is in trouble. And here's what's already happening on the ground. Local small businesses have reported delayed wire transfers and frozen credit lines. Real people are already feeling the impact. Case study number 2, a community bank in the Southeast. Smaller institution, $2 billion in assets, lent heavily to office developers during the 2020 to 2022 boom. Now those loans are defaulting. Their deposit base has shrunk by 20% in the last 18 months. They reported losses in 3 of the last 4 quarters, and their stock price has dropped over 50% from its peak. This bank is on life support. Business owners in that region are quietly moving their accounts to larger institutions because they've seen the warning signs. I'm not naming them because I can't prove they're on the FDIC problem bank list. But the data suggests they're either on it or very close to being added. And there are dozens of banks across the country with similar profiles. So here's what you do. Evaluate your own bank using these 5 warning signs. If your bank checks multiple boxes, it's time to start asking serious questions. Don't wait for the FDIC to warn you. By the time they do, it's already too late. If you think your bank is 100% safe and the government would never lie to you, comment SAFE. If you're starting to realize this is way bigger than they're telling us, comment warned. Let's see where everyone stands. All right, let's talk about the elephant in the room. Why is the government hiding this? Why won't you went to FDIC just release the names of the 99 banks and let people make informed decisions? The official answer is simple. They don't want to cause a panic. If tomorrow morning the FDIC published a list of failing banks, depositors would rush to withdraw their money. Bank runs would start, and even healthy banks could get caught in the chaos. So they keep a secret to maintain confidence in the system. But there's more to it than that. Let's break down the real reasons they're hiding the crisis. Reason number 1, too big to fail logic. The government doesn't want to admit that the banking system is fragile. Because if people lose faith in banks, they lose faith in the entire financial system. And once that happens, the economy collapses. So they bury the problem, hoping they can manage failures quietly without triggering mass panic. Here's the truth they understand. People do you in panic because banks fail. Banks fail because people panic. That's why they'll never release the list. Reason number 2, political optics. We just came out of a contentious election cycle. The economy was a major issue. Inflation, interest rates, banking civility was all on the table. Imagine if, right before or after an election, the FDIC announced that 99 banks were failing. That would be political suicide for whoever's in power. So they delayed, they downplayed, and they kept it under wraps. Reason number 3, avoiding panic before earnings season. Banks report earnings every quarter. If the FDIC releases the problem bank list right before earnings, it could tank stock prices and create a feedback loop of fear. So they time their updates strategically, hoping to minimize market disruption. Reason number 4, the Federal Reserve's Band-Aid tools. The Fed has created emergency lending programs like the Bank Term Funding Program to give struggling banks access to liquidity. The idea is to keep banks afloat long enough for interest rates to come down and for balance sheets to recover. But here's the problem. These are temporary fixes. They don't address the underlying issues. They just delay the inevitable. The government is buying time. They're hoping the economy stabilizes, commercial real estate recovers, and deposit flight slows down. But hope is not a strategy. And the data shows that the problems are getting worse, not better. The FDIC can't hide the balance sheet damage forever. At some point, the losses become too big to ignore. And when that happens, the crisis they've been trying to prevent will explode anyway. Only now, it'll all be worse, because no one was prepared. Before we get into what happens if these banks actually collapse, let me ask you something. Do you personally know anyone who lost money in the 2023 Silicon Valley Bank failure? Comment yes or no, because what's coming could affect 10 times as many people. So let's talk worst case scenarios. What actually happens if these 99 banks fail? Because the range of outcomes varies wildly depending on how fast it happens and how the government responds. Let me give you 3 possible scenarios for 2025. Scenario number 1. Controlled failures. This is the best case outcome. The FDIC quietly manages the collapse of smaller banks by merging them with healthier institutions. Depositors are made whole. Shareholders get wiped out. Bondholders take losses. But the broader system stays stable. There are a few panic waves in the media, but the contagion is contained. This is what the FDIC is hoping for. It's manageable, controlled, and doesn't crash the economy. Scenario number 2. Regional banking crisis 2.0. This is where things get messy. Instead of 1 or 2 banks failing quietly, 10 to 20 regional banks collapse over a 3 to 6 month period. Depositors panic. The stock market sells off. Credit markets tighten. Small businesses lose access to loans. The Federal Reserve is forced to cut interest rates in an emergency move. The Treasury steps in with bailouts. It's ugly, it's chaotic, but the system survives. This is what happened in 2023 with Silicon Valley Bank, Signature, and First Republic. It's painful, but not catastrophic. Scenario number 3. Full-scale contagion event. This is the nightmare scenario. A major bank fails, not a small regional bank, but a large institution with systemic importance. Confidence in the entire banking system evaporates. Depositors rush to withdraw their money from every bank, not just the failing ones. Credit markets freeze. Businesses can't access capital. Stock markets crash. The Federal Reserve and Treasury are forced to implement emergency measures rate cuts. Unlimited liquidity injections, maybe even a temporary freeze on withdrawals. It's 2008 all over again, but faster and more digital. A digital age bank run is like a wildfire. Once it starts, it moves faster than anyone can contain. This scenario would trigger a severe recession, massive job losses, and a complete restructuring of the banking system. Which scenario is most likely? Honestly, I'd put my money on scenario 2. A regional banking crisis. We're already seeing the early signs. Banks are struggling. Deposits are fleeing. Commercial real estate is collapsing. And the FDIC is scrambling to manage the fallout. I do think we reheaded for a full-scale contagion event because the government will intervene before it gets that bad. But I also don't think this gets resolved quietly. There will be failures, there will be panic, and there will be consequences. The question isn't whether more banks will fail. The question is how many, how fast, and whether you're prepared when it happens. We're about to hit the action steps, the part where I tell you exactly what to do. But first, are you still watching? Drop an emoji right now. Because if you've made it this far, you're in the top 5% of people who actually take their financial security seriously. Alright, enough doom and gloom. Here's how to stay on the safe side of this crisis. Let's talk about what you can actually do to protect yourself. Because this isn't about fear-mongering, this is about risk awareness. And if you take action now, you can safeguard your money before things get worse. Here are 5 practical steps you can take this week. Step number 1. Stay under the $250,000 FDIC limit per bank. If you have more than $250,000 in deposits, spread it across multiple banks. Don't keep all your money in one institution. The FDIC insurance only covers up to $250,000 per depositor, per bank, per ownership category. So if you have $500,000, put $250,000 in one bank and $250,000 in another. Simple, effective, and it guarantees your money is protected. Step number 2. Check your bank's financial health. Go to your bank's website. Look up their investor relations page. Download their latest quarterly earnings report. Check their Tier 1 capital ratio. Look at their loan portfolio. See if they're heavily exposed to commercial real estate. Read the management discussion section to see if they're acknowledging problems or pretending everything's fine. This takes 20 minutes, and it could save you from losing thousands of dollars. Step number 3. Diversify beyond traditional banks. Don't keep all your cash in checking and savings accounts. Look at credit unions. They're often safer than small regional banks because they have different regulatory structures and less risky lending practices. Look at treasury bills. These are backed by the full faith and credit of the U.S. government, which means they're as safe as it gets. Look at money market funds. They offer higher yields than savings accounts and are extremely low risk. Step number 4. Monitor your bank's liquidity and branch activity. If your bank starts closing branches rapidly, that's a red flag. If they're offering unusually high interest rates to attract deposits, that's a red flag. If you start seeing news reports about their struggles, don't ignore it. Move your money before the panic starts. Because once a bank run begins, it's too late. You'll be stuck in line with everyone else trying to get their money out. Step number 5. Have a plan. Know exactly what you would do if your bank failed tomorrow. Do you have backup accounts at other institutions? Do you have cash on hand? Do you know how to contact the FDIC to file a claim? Most people have no plan. And when a crisis hits, they panic and make terrible decisions. Don't be one of those people. Take 30 minutes this week to map out your contingency plan. And let me be very clear about something. This is not financial advice. I'm not a financial advisor. I'm not telling you to pull all your money out of banks and bury it in your backyard. What I'm saying is this. The risks are real. The data is undeniable. And the government won't warn you until it's too late. So take responsibility for your own financial security. Educate yourself, evaluate your bank, and make informed decisions. Because the people who survive banking crises aren't the ones with the most money. They're the ones who saw it coming and acted early. Preparedness beats panic every single time. Bank failures don't happen slowly anymore. They happen overnight. One bad headline, one credit downgrade, one wave of panic hand a bank that seemed perfectly safe yesterday is gone today. 19 banks are on the FDIC problem bank list right now. The government won't tell you which ones. But the warning signs are everywhere if you know where to look. Commercial real estate is collapsing. Unrealized losses are piling up. Deposits are fleeing. And the next crisis is building in real time. Now, if you want me to go even deeper, I am working on my next video. The $900 trillion derivatives bomb and why it could collapse the entire global financial system. If you want that video, comment the word derivatives right now. I need to know if you're ready for the next level. Also, drop a comment and tell me, do you think your bank is safe? Or are you already moving your money? I'm reading every single comment. If this video opened your eyes, smash that like button. If you want more deep dives into the financial system that runs your life, hit subscribe and turn on notifications. Because the truth isn't going to come from the government. It's going to come from people like us who are paying attention. Stay aware, stay informed, and protect your money. I'll see you in the next one.